Good afternoon and thanks for tuning into the newsroom on ET Now. I am Jayesh Khilnani and the time right now 1 p.m. Let's get you a quick check of how the markets are faring this Monday afternoon. It has been down and out. There has been a lot of pressure on the markets on the downside, and that is courtesy a lot of domestic as well as global factors that we have been tracking. But as far as the levels are concerned, the Nifty as well as the Nifty Bank both have now shed more than 5% from the highest point of April this year itself. Interestingly, with today's market fall, both the Nifty as well as the Nifty Bank have now tested their 200-day moving average as well. The India VIX index, that has been the major contributor on account of which the market has been declining. That's the one which is up about 10% and identical open and open and low levels for those as far as the volatility index is concerned. From the broader market space, mid-cap as well as small-cap index also reeling under pressure. The Nifty small-cap index trading with open equal to high as well. The two big sectors that are putting pressure on the markets today have been the IT as well as the banking pack, and those will come up for you on the screen. So that's broadly the market check that we have at 1 p.m. But on that note, let me also welcome in our guest, Samir Narayan, who's the head of PMS at Invesco Asset Management. Good afternoon, Samir. And, it's been a tough market of late with a lot of ups and downs to deploy incremental money. So let me ask you by, starting off with what would you do if you had about, let's say, 1 lakh rupees of incremental money? How would you actually split that in your portfolio?
Hi, Jayesh, and thank you. Good afternoon to everybody, and thanks for having me. I think, as you rightly said, the way the markets are positioned right now, we are digesting a lot of data. Now, at the margin, there is a lot of incremental data that has come worse off than expected. For example, you had the inflation number that has been going up. You've had the big numbers from Infosys and HDFC Bank, which have been slightly lower than expectation. Plus, globally, you are having your US yield spiking above 2.8 after a long time. So I think these are things that the market is right now digesting. But having said that, there is a global backdrop of the war narrative. Where are we heading? The inflation, are we behind the peak? And on the local side, the correction in earnings. So I think today, if you ask me, we've always seen historically as well that it is actually in such times of so-called negativism or on negativity and pessimism that if you actually put money to work, it gives you the best returns from that point onwards. So even though today the market Nifty might be down 400 points, we are again testing 17,000. But I think all is not lost because these are things that are transitory and these will roll over. So I would say that people should take a judicious approach towards putting money to work at regular intervals. And to answer your question, since you said 1 lakh rupees, I think you should stick to your asset allocation plan for which you already have advisors. And just because don't be swayed by this gloom of despondency that has suddenly descended upon us today just because markets have taken a correction today. So I think the overall thesis doesn't change. The India growth story doesn't get ruptured. But it is that, yes, we've had a good run. I mean, even today, if you see on a 1 year basis, a 22% kind of a return is not bad for any market as such. And if you look at Dow on a 1 year basis, trailing is flat, whereas Indian market has delivered handsome returns. So I think to that extent, the premium multiple that we were ascribed or we were getting relative to the developed market, that has got taken off a bit, which is fine.
Right. Samir, interestingly, I was just looking at the recent fact sheet which you have shared with our team, and I noticed that in the sector allocation, there is not, any mention of any financial stocks or banking stocks, So that was the interesting point that I wanted to check with you. What's the stance on financials and banking space that you have at the moment?
Well, I think firstly, which fact sheet are you referring to? Because we have a reasonable representation to financials across all our products because financials by themselves happen to be a very large weight in the index. So if you're asking about the mid and small cap product, which is Caterpillar, well, there it is a very niche product, which is basically we aim to capture those names where we see a translation from, say, the cocoon to a caterpillar to butterfly. So we aim to capture companies which have a large opportunity of growth, which are available at reasonable entry valuations and who don't require capital. As in they are not, it's a non-linear growth, so they are not capital hungry. So therefore, in that product, we don't have much exposure to financials. But otherwise, across our schemes, we have a reasonable weight because financials are almost 35% of the benchmark.
Right. Let me also check in with you on the earnings front. Now, it's been very early days. We've had a couple of IT companies and one HDFC Bank that have reported numbers, and of course, the stock reaction is there for you to see. But what have you read into the earnings so far? There have been two less number that has been reported, but still, what's the initial sense that you're making of the Q4 numbers?
Well, Jayesh, I think it is very early days, but yeah, if you look at right now, the couple of results that have got reported, the tech bellwethers, TCS, Infosys, and HDFC Bank. Well, there is growth. So in fact, on the tech side, you can clearly see even right now the volume growth commentary is still quite optimistic, and the outlook is also still pretty much there. It is just that yes, in the short term, because you are likely to see some amount of margin pressures on account of the lot of attrition. Because see, attrition is also a function that there's a lot of end demand. So therefore, people have got movable or rather optionality, and there is a reasonable amount of movable options available for people as well. But I think from the earnings front, we are not at all. I don't think it anyway punches the thesis in terms of the growth for the sector. And on the banking side as well, I think India is just about getting onto the credit cycle. So therefore, you're likely to see, sir, from here onwards, credit growth will pick up definitely. We used to be 6-7%, and we've already come to about 8-8.5. So I think from here we should trend upwards as and when things start. Because see, we have to also understand and appreciate that the full impact of a complete post-COVID era is now getting unleashed. Offices are opening up, people are moving about, so those things are beginning to happen now. But at the same time, we have suddenly been seeing this now post, once we got done with COVID, we have this post conflict. So in the post conflict era, you've got India being a large crude importer. There is obviously implications for the margins. But I think at the end of the day, in case the revenue line is good, margins over a period of time will tend to come back. So it's a question of a timing issue. We are not so bothered about the timing aspect, because it would be transitory in nature. And at the end of the day, if you look at on a 2-year CAGR basis, I think the Indian markets are still quite well positioned to deliver a 15-18% kind of a earnings CAGR.
Right. Samir, one final question. What is the one risk that you are keenly watching out for, which could actually derail the markets?
Well, Judge, I think right now the global risk is quite honestly the an unknown, because in case the conflict escalates, you don't know where it will go to, and once that happens, one doesn't know how the world will respond. So right now, although the Fed is clearly positioned towards sort of taming in inflation, and suddenly if you realize that the global growth has taken a backseat because of maybe supply chain dislocations and a lot of the realignment that is likely to happen in a case of a prolonged conflict, then maybe the whole argument could change again. So I think those are it's the global factors where we are probably having far more concerns. And the trickle down of those as a result of those global factors basically for Indian companies is that because a lot of the raw material gets imported and supply chains are dislocated, logistics costs have gone up. So therefore, there is the profitability measure and the margin pressure is something how the companies handle that and manage that in the immediate 2-3 quarters is something that we are looking at. But otherwise, I think Indian market growth is something that we are not very concerned about. That yes, over the couple of year CAGR, I think 2-year CAGR we are quite well positioned to deliver handsome EPS on the Nifty at least.
Right. Thank you so much, Samir. We'll let you go on that note. But once again, thanks for taking the time out and speaking with ET Now. On
Pleasure,
that note,
James.
let's
Thank
slip
you.
into a short break. On the other side, we will get you some of the stocks that have been buzzing in trade today.